Would you like to invest in real estate but simply don't have a huge amount of money needed to buy your first property nor a line of credit? Would you like to have somebody manage your property for you? Would you also like to build a diversified real estate portfolio? Now, if any of these sound appealing to you, real estate investment trusts, also known as REITs, might just be the thing you need. And in this video, we will go over everything you need to know about REITs, what they are, what they let you do, how they make money, and how to analyze them. But before we do, feel free to leave a like on the video, cause every like, share and comment help the channel out tremendously and I really appreciate it. If you're new here, feel free to subscribe for more personal finance, investing, business and motivation related videos, as well as weekly book summaries. What are REITs? A real estate investment trust, or REIT, is often defined as a company that owns, operates or finances income-generating real estate. They allow investors to buy shares of a real estate portfolio and thus invest in real estate without having to buy an entire property themselves. So a REIT is basically a company that invests in real estate, takes care of all the property management, collects rents, and distributes most of those rents to its shareholders. REITs must distribute at least 90% of their profits to shareholders. This is why they're considered a great source of passive income. Now, bear in mind that they're considered what's known as a pass-through entity, and as such, they don't have to pay corporate taxes on their profits. Because of that, the dividends the shareholders receive from REITs are taxed as ordinary income. Most REITs are publicly traded just like any other stock, but there are also public but non-listed REITs as well as private REITs. Besides individual REITs, there are also ETFs and mutual funds that are centered around REITs. Some REITs are even part of the S&P 500, and pretty much any total market index fund has at least some portion of it in REITs. The fact that REITs trade like a stock means that you can invest in real estate with as low as a couple of bucks or even less. And since there aren't many real estate properties that you could buy for a couple of bucks lying around, this basically removes the barrier of entry and lets you diversify your stock portfolio by adding real estate exposure to it. An added benefit is that you can buy and sell REIT shares multiple times a day if you want, unlike physical real estate which can take months to buy or sell. So this basically removes the liquidity issues tied to real estate also. And on top of that, instead of investing in like just one rental property for example, you get to own a portion of a diversified real estate portfolio, which consists of many different properties that have many different tenants paying rent. And as icing on the cake, the REIT manages all of them for you, so you don't have to fix toilets either. Okay, but how do REITs even make money? Well, some REITs buy income producing properties and rent them out. Some build the properties themselves, while some simply focus on financing real estate investors, for example by providing mortgages. So most REITs can basically be separated into two baskets: equity REITs and mortgage REITs, but there are also hybrid REITs on top of that which are a mixture of both. Equity REITs are by far the most common type of REITs. They own and or operate income producing real estate, so they make money off of the rent payments that they receive from their tenants. In most cases, whenever someone mentions the term REIT, an equity REIT is what they actually have in mind. Here are some examples of the types of properties that equity REITs typically invest in: residential buildings, malls, hotels, like buttons on videos, self-storage, office spaces, hospitals, senior housing, cell towers, data centers, industrial buildings, and so on. Mortgage REITs, also known as M-REITs, invest in mortgages and other mortgage-related assets, such as mortgage-backed securities. So they don't even hold physical real estate, they just invest in loans that revolve around real estate and make money off of the interest. M-REITs sometimes borrow piles of money or short-term at low interest rates and use it to buy mortgages that have higher interest rates. They're basically financial stocks, much like insurance companies or banks. Hybrid REITs are just a combination of the equity REITs and mortgage REITs. They both own and or operate real estate as well as invest in real estate related financial assets. So they both make money off of the rents from tenants as well as from interest on mortgages. Now, you can't just start a company and buy some real estate along the way and because of that call the company a REIT. There are some specific requirements that a company must meet to qualify as a REIT. So, the company must invest at least 75% of its total assets in real estate, derive at least 75% of its gross income from rents from real estate, interest on mortgages financing real estate, or from sales of real estate. It must pay at least 90% of its taxable income in the form of shareholder dividends each year, be an entity that is taxable as a corporation, be managed by a board of directors or trustees, have a minimum of 100 shareholders, and have no more than 50% of its shares held by 5 or fewer individuals. Okay, now that we finally know what REITs are, let's talk about analyzing them. When it comes to analyzing REITs, traditional metrics such as price per earnings ratio or PE and earnings per share are really not reliable indicators. Luckily, metrics such as FFO and AFFO fix those drawbacks by ignoring depreciation costs and can be used as a way more reliable indicators. But why are those even needed? Well, whenever a REIT buys a building, they have to charge depreciation against it on their balance sheet. And since this depreciation is not a cash expense and it doesn't impact the cash flow of the property, it doesn't affect the actual profits of the REIT. For example, if a REIT has an income of 150 million in a given period, has property maintenance costs of 100 million, interest expenses of 20 million, and depreciation costs of 20 million, that will on paper leave it with 10 million in profits. In reality though, depreciation is not a cash expense. The building maybe didn't even lose that amount of value in that period. And this did not affect the cash flow of the building, so the real profit that can be distributed to shareholders is actually 30 million here. Funds from operations, also known as FFO, adds depreciation cost back to net income and also subtracts any gains on the sales of depreciable property, thus giving us a way more accurate figure to work with. Adjusted funds from operations, also known as AFFO, further expands the calculation by deducting any capital expenditures and is therefore the most precise measure of residual cash flow available to shareholders, and we can use it to estimate how likely a REIT is to keep paying or even grow its dividends. If we take the market cap of our REIT and divide it by FFO or AFFO, we will get price to FFO or price to AFFO multiples, which are pretty much the REIT equivalent of a PE ratio. Pretty similarly to PE ratio, they can be a nice quick way to assess whether a REIT is undervalued or overvalued, but just like PE ratio, they vary drastically depending on the market conditions and REIT subcategory. Now here are a few extra things to watch out for when analyzing a REIT. Take a close look at their debt structure and see if there is any variable interest rate debt. If so, a big increase in interest rates could put the REIT in a tough spot, severely impacting its ability to pay dividends. Pay attention to what areas the REIT is planning to expand next and what kind of properties they are looking to acquire or develop. Make sure there's no oversupply of that type of property in that area. Closely analyze the like button on this video and try to make sure it's firmly pressed. Take a look at the current leases, when they expire and how big a share of the income do those tenants whose leases are soon to expire take up. Note that the type of property a REIT invests in will directly determine how sensitive to recessions and things like pandemics that REIT is. And our final point for today is how good an investment are REITs actually, compared to the stock market at least. Well, over the long run, they seem to outperform many stock market indexes, including the S&P 500. Take a look at a couple of tables and charts available online. As you can see, the numbers look impressive, but there are still a couple of things to bear in mind. First is the fact that not all subcategories of REITs perform equally, as you can see on one of the tables. Luckily, you do get to choose which REIT to buy, and you should know what kind of properties they invest in. It's even more important to note that REIT performance is very dependent on interest rates. Since REITs distribute most of their profits, they have to use debt to grow, and if that is cheaper, they will be able to grow way faster and maybe even refinance some of their old debt. But if the rates stay high for long, they are likely to grow slower and some might even struggle to maintain dividends. To summarize, what are REITs? A real estate investment trust, REIT, is often defined as a company that owns, operates, or finances income-generating real estate. REITs must distribute at least 90% of their profits to shareholders, so they're a great way to get passive income from investing into real estate without a pile of money on your hands or having to fix toilets. How REITs make money? Equity REITs buy income-producing properties and rent them out, thus making money by collecting rents. Mortgage REITs or MREITs focus on financing real estate, for example by providing mortgages, thus making money off of the interest. There are also hybrid REITs that do a bit of both at the same time. How to analyze REITs? When it comes to analyzing REITs, traditional metrics such as PE ratio and earnings per share are not good indicators. Luckily, metrics such as FFO and AFFO fix their drawbacks. AFFO is the most precise measure of residual cash flow available to shareholders, and we can use it to estimate how likely a REIT is to keep paying or even grow its dividend. REITs versus the market. REITs have historically managed to beat the market over the long run, but that might change in the future as they are heavily reliant on interest rates and the outlook of the economy. Thank you for watching, and I really hope this video was useful to you. As a final note, let me clarify that none of this is investment advice. You should always do your own due diligence before investing, as it's your money and you and only you are responsible for the consequences of your own actions. With that out of the way, thank you all for sharing the videos with friends and of course destroying the like button. There's much more investing, personal finance, business and motivation related content on the way, as well as weekly book summaries, so feel free to subscribe if you have not done so yet. I'll see you next week, so enjoy the rest of your day. Bye bye!